Right now, the average 50th percentile pre-seed is $1 million on, I think it's a 12 million post-money cap. You're a founder. What's pre-seed? No revenue. Very little bit of knowledge about customers, right? Little bit of knowledge about your market. Grandiose idea. Any pre-seed fund is structured, as we know, to need power law returns, right? Because of the high probability of failure. They are looking at you, founder, and they are saying, we need a power law, so we're making a bet that you can have a 100x outcome. Let's just reverse engineer that math. You know nothing about anything. You've taken $1 million, very small amount of money to figure out what the future looks like, and you're signing up for a $1.2 billion exit, 100 times 12, and that's with no additional dilution.
Within 7 years. Welcome to the Inside the Fund podcast, where we go on the other side of the table and learn about capital raising from VCs. I'm Helena Fogarty. I'm a fundraising expert who helps startups raise their seed and Series A rounds. And today I'm speaking with Brice Scheschuk. Brice is a managing partner of Global Live Capital, a Toronto-based family office and investment platform focused on venture technology and innovation. But Brice isn't your typical VC. He's an operator turned investor with a rare perspective that challenges much of Silicon Valley's conventional wisdom about fundraising and venture capital. His central thesis that 99.9% of companies should not raise venture capital, and that the ecosystem has created a dangerous mythology around VC as the only path to success. So happy to have you here. I think I've been stalking you for probably a year. You were so kind to respond to my LinkedIn message and even turn me on to Catherine Brice's book, World Eaters,
yes,
which was amazing.
Yeah, super interesting.
And now Liesl Leach and I, who work together at Backable, are obsessed about this idea of another pathway to funding.
Yes.
And finding the right funding for startups, for companies. But I'd like to start with your origin story. So take me back to how you got here.
So short on it is I grew up in a place north of North Dakota called Saskatchewan. So I kind of publicized my home province. Worse weather than North Dakota, which is a feat. Grew up there, typical middle-class existence, kind of got out of there, joined the Naval Reserve right about the time of graduating high school. Spent a year kind of training, and then I went to university on the east coast of Canada in Halifax, Nova Scotia, a place called Dalhousie. I like to say to people, I did a commerce degree. I graduated in 94, and I don't remember the word entrepreneur being said once in my commerce degree.
I'm not
Now,
surprised.
you fast forward now, and there's definitely been significant advancement in the entrepreneurial educational thinking, but back then it was traditional business training for those jobs that we know, the corporate jobs. Graduated, came to Toronto. As you said, PricewaterhouseCoopers, at the time it was called Coopers & Lybrand, did what is a CPA in the US, and wasn't my groove, but I enjoyed the experience, went into consulting, and then we had this thing that we all know called .com one. 4 buds, myself and 3 others, all professional services guys, saw an opportunity to do a .com one business focused on bringing investor relations for small companies into the modern age. Okay, in hindsight, you look back and you kind of laugh at the rudimentary nature of this, but it was a thing at the time.
Yeah.
And we did the 1998 to 2001 up and then all the way down. It was a Me Too business. It wasn't that interesting in hindsight and so on, but we learned a lot about the startup journey. And that failure, I say, is my MBA.
Yeah.
Okay, I never did an MBA. I did the accounting thing, and I'm like, that was my MBA. In Canada, after 2001, when everything dried up, it was a dark time for tech. Basically, the ecosystem went away.
Yeah.
So I had to get a job.
Yeah.
I did that for a year and a half. And then, if you can believe it, the serendipity of life, I got called by a recruiter saying there's this young entrepreneur in Toronto who's building telecom businesses and he's looking to beef his team up. And so I went and met him. And you know that thing you do when you meet a person for an hour, pretty inspiring guy. I was looking to leave where I was, and it's like, I'm going to throw my lot in and let's see where this goes. Fast forward, we spend 5 years building non-wireless telecom businesses. It was such a fun journey, buying companies, selling companies, growing organically, pirate ship culture, all of that goodness.
Yeah.
And then in late 2007, the Canadian government looked at our telecom oligopoly wireless. 3 companies. To compare to the US, think of 3 Verizons or 3 AT&Ts.
Yeah.
uncompetitive. We had the lowest penetration of wireless in the developed world, and we had the highest bills, and they had the highest profit margins. That was when the iPhone was coming out. Think that the smartphone was rising, and the Canadian government, to their credit, said we have to introduce competition to this oligopoly. The way they did it, it gave an entry point for Canadian non-existing wireless companies, and we went around the world, and with a very long tail that I will not do today, with very few days before a bid deposit deadline, we met an Egyptian billionaire named Naguib Sawiris, a fascinating man. He funded, brought some of his team in. We brought our team together, and we built Canada's fourth wireless company. Long tail. In 2016, through a bunch of events, we sold that to Shaw, as you mentioned, a cable company out west in Canada. Good outcome. We didn't want to sell personally. We thought we had another great 10-year run, but we sold. We took the proceeds of that liquidity, and basically we all changed jobs. We stayed together. We built an investment platform called Global Life Capital, which is a family office platform. And in the mid-2010s in Canada, we're always behind the US, but we kind of follow the US trends. So things in the US were percolating into Canada, Techstars. A lot of Canadian founders were going to YC. Founder Institute was coming up here. Our universities were starting to understand the need for innovative thinking. And we had a good brand, and we're like, we have a chance here, we think, to get alpha by investing in the next generation of Canadian founders that were really being built up. And we think there's something interesting here. Fast forward a decade. We've invested in 130 or 150, call it tech venture innovation startups. Importantly, we've invested in 50 venture funds as LPs. So we've also seen the LP side of the table. And when you look at what has happened in the last decade, it's fascinating, right? I like to break our timeline of investing into the following, which is what really informs our discussion. 2016, when we really started investing, to 2019, I call it the golden era of SaaS, right? Everything was kind of moving and more capital was flowing, and SaaS businesses were getting momentum and steam. We have the short blip in COVID where things got pretty scary for a minute, but then stimulus and government subsidies and zero interest rates, capital flow in. We had the bubble of the back half of 2021 and the front half of 22. Things went completely haywire, including in Canada.
Yeah.
And then it crashes.
Yep.
In the back half of 22, it got super dark, same patterns in Canada. And then, I don't want to denigrate VC at all, but they need a narrative. They need a story. And with ChatGPT and the LLM rise, it gave the AI tailwind, and it allowed them to move to a new narrative, while all these companies from that earlier cohort that got funded in bubble style funding sit there and they're like, the tide is out. What is going to happen here?
Yeah.
And so I've been watching the rise of the new narrative, the fall of the old narrative. I've looked very closely at our portfolio. I've analyzed kind of what's happened to founders and so on. And you mentioned the not-for-profit. We set that up in that journey. And about a year and a half ago, I created a workshop. It kept coming to me. Is this a sensible capital narrative for our ecosystem to push founders always to raise VC, accelerators, even university program, mentor? Everyone is kind of programmed that the measure of success of a founder as it relates to capital is high velocity, high growth, lots of dollars, boom, 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 and let's see where the chips lie. And it hit me that narrative actually needs some balance. And so a year and a half ago, I asked a conference in Canada. They asked me to do a keynote. I said, I'm going to create a new presentation I want to test at your conference. They were very happy to do that. I launched it. Best received thing I've done publicly. And I've done it 45 times now since then. Yeah. And it just keeps on resonating with founders, because in Canada, I'm one of a very few who's talking about, again, not denigrating VC, but fitting it into a balanced capital narrative of where it makes the most sense. You and I connected from there, and here we are today. So that's kind of the background.
And I think the point is, and you know this from your background, like when you're building a company, if you get to $20 million in ARR, that's a huge feat.
Unbelievable.
And yet, it's not at all interesting to be seed.
Totally.
That's not the goal.
Exactly.
You've got to go bigger.
You got to go bigger.
So there has to be a solution for businesses that are shooting for this mid-range to find the resources to grow. Because that can be a life-changing exit for those founders and for anyone who's involved if once they're acquired or they, whatever I guess acquired would be it because they're not going to go public.
Exactly. Yeah.
Yeah.
So yes, yes, and yes is really the answer. But let's talk about that in a bit more of a nuanced way. So to give you like some points here, I'm a member of an exited founder group in southwestern Ontario, tech and telecom. 35 people, 5 raised VC, 30 did not. The average length of business build, 20 to 25 years. These are not 5-year builds, even though it feels velocity-wise like it should be. No business is a 5-year build from scratch.
Right.
And the reason the stats are skewed towards non-VC is the ones that succeeded and survived in ratio are generally more tilted to bootstrap because of that high velocity risk you take.
Yeah.
So fascinating, right? Then you start to drill into, okay, so what does another way look like? And it's really interesting because it's somewhat unsystematic, but if I could talk through patterns, here's what I would say. I use Canada's darling of this generation tech company as my prime example. And that company is Shopify, and everyone knows it in the world. It's a top 50 global tech company. It is the company in Canada of our generation. It's the highest market cap company in our country, okay? So what no one talks about with Shopify is that the founder, a German immigrant to Canada who met the love of his life, a Canadian gal, spent 6 years in the basement, in the wilderness, trying to figure out if he had market, product, customer making sense at a higher scale business. 6 years. He's a very methodical, first principles thinker. He bootstrapped. He raised dribs and drabs from angels, including like family, $1 million over 6 years.
Yeah.
Did all the things that you and I would do to bootstrap, to figure out product market fit, and then to start to understand growth. As I understand the story, in his 5th year, he spent $250, he had $1 million in the bank. He'd raised $1 million, he'd kind of got to it, he kind of kept it steady. He spent $250,000 on 5 growth experiments of 50 grand each. They all hit, and it showed him that something was really working, and there was some math to his go-to-market.
Yeah.
He had been reviewing a lot of online resources to understand the metrics of his business and so on, and it happened to be he'd keyed in on Bessemer. He went down to the valley after that 6-year period, kind of meeting of the minds with Bessemer, raised, as I understand it, 10 on over 100, had a great raise. They loved the thesis, and the rest is history. What we don't talk about is he waited to actually understand if he had a venture backable business before actually putting the capital and the fuel into his cap table.
Yeah.
And so what I see a lot of is if you do a little reverse engineering exercise, which I do with founders a lot, pre-seed metrics, 50th percentile from Carta data, which they are great at publishing anonymized data. Right now, the average 50th percentile pre-seed is $1 million on, I think it's a 12 million post-money cap, okay? You're a founder. What's pre-seed? No revenue. Very little bit of knowledge about customers, right? Little bit of knowledge about your market, grandiose idea, okay? Any pre-seed fund is structured, as we know, to need power law returns, right? Because of the high probability of failure. So they are looking at you, founder, and they are saying, we need a power law, so we're making a bet that you can have a 100x outcome, right? Let's just reverse engineer that math. You know nothing about anything. You've taken $1 million, very small amount of money to figure out what the future looks like, and you're signing up for a $1.2 billion exit, 100 times 12, And that's with no additional dilution.
Within 7 years.
Within a short period of time, which, by the way, is
Could be 5 or
completely
10 or
completely fake.
Yeah.
We've seen now the reality of that. That
Yeah.
is totally fake. I mentioned 20 years. I think the VC funds that I'm in that are getting near the 10-year, they've all extended.
Yes.
And they're now starting to ask for extensions beyond the 12. Okay. So what we're going to see, the world isn't how you wish it would be.
Yeah.
The world is how it is. And how it is when you start a company, it actually can take 15 to 20 years to get to conclusion. I've seen the data consistently. So founders, so what I like to compare and contrast is I said, so Toby Lutke is his name, and he ground out the crappy work of bootstrapping, of living in the parent-in-law's basement, of eating lean, of not going on the big trips, grinding out 18-hour days for that 6 years, and there's nothing sexy.
Yeah,
Okay.
and if he's married, there's also pressure there.
Exactly.
Yeah.
Not
like,
spending.
Why aren't you getting a job?
All of that.
Yes.
Kind of worked through, I think, a very supportive partner,
Right.
probably helped him in the business. I don't really know all the details. But it's like the act of that type of grind compared to the sexy grind that gets narrated for the $1 million raiser that then goes on the conference circuit and talks about how they fundraised and pre-seed and so on. The real business work is done in that lean phase, and done right, you have great ownership and you have a much higher, not a great probability of success, but if you decide to put that fuel on with go-to-market understanding advanced, you have a chance.
Yeah.
Now, again, I'm talking a lot here I'm kind of just going in my train of thought. Now, of course, the issue with that is, well, it's hard to bootstrap. Are there ways of getting some capital that can help you that doesn't blow you up before it's because it's too early? And then you start going into, okay, there's 10, 15 sources of capital that I talk about. It's probably a little different in Canada, the US, but not that much different. And we can hit that as you see fit.
Yeah, well, I think to your point, there are other investors that could be available to you as a founder that don't need that power law return and would be very happy with a different, a 4-time, 5-time return within a certain period of time through an acquisition.
Absolutely.
But it's just finding the right people to be on your cap table.
Absolutely. Exactly. So good entree. So I'll go in a couple of directions. So there is definitively an investor pool, some in Canada, a lot in the US, can be angels. There's even some institutional that understand the capital efficiency narrative, but with reasonable growth. So not no growth.
Right.
Okay. And when you combine those a certain way, the actual outcomes can be just fine. And the risk-adjusted returns on these, at least in what I'm seeing in my experience, have been probably better than venture performance in our portfolio. And candidly, what I say to founders is I say, look, let's do power law math for a moment. VC pre-seed seed fund. Even though the world changes quickly in VC, particularly in this AI era, humor me for this. $100 million fund. I'm going to do $51 million pre-seed seed checks. I'm going to reserve the rest for fees and for follow-on. Okay. What is the power law expected outcome? Most founders don't understand this. Okay. Of the 50, 40 will fail. And by failure, like 1x to lower.
Yeah.
Okay. 40. 5, 6 will do 1 to 2x. A very uninteresting outcome, pretty crappy for founders. Okay. 2 or 3 will get to the 5 to 10x, let's call it. And 1 will hopefully power law.
Yeah.
In fact, the stats I don't think are that good. But let's say that's the dream. Okay. And you distribute that and you end up with something that should make sense for investors, although we'll talk about the investor side of this. Okay. So we can talk about this till the cows come home. We can understand the investor narrative. We can understand the distributions and so on. What we forget is, I call the 50 a lottery ticket. It's a very bet-driven business. And when I do these workshops, I say to founders, I just want you to understand that you are one punch on that 50 number lottery ticket, and your probabilities are what we just talked about. So you have to understand and walk in the shoes of the capital you're raising, no matter what type it is. And when 99.9% of the oxygen that's coming into your brain, because every other founder you talk to has been programmed this way, every accelerator that you go into and talk to, the institutional community itself, with you start listening to the podcast, they're dominated by this narrative.
Yes.
You actually don't know another way.
Mm-hmm.
So I'll bring it back to bootstrapped, sometimes co-founder savings, unconventional narrative. VCs hate service revenue. We know that, right? It's low enterprise value
Yeah,
multiple.
we were just talking about that. Yeah.
Yeah. Do you know how many founders I have met that use services to fund and avoid that early dilution that then turned into a product and had success?
I don't know how many, but I know they're
It's a
quite
beautiful
few.
narrative. You know,
Yeah,
I'll tell you a
great.
story. I tell this story a lot. I was doing the workshop at a university in Montreal called McGill, like good, high quality Canadian
Yeah.
school.
Great school.
Yeah, I had probably 25, 30 kids in the room. After, when I was doing the after just discussion with people, two young guys came up and they said, "We got a question for you, Brice." And I said, "Fire away." They said, "Should we quit school or not?" I'm like, "Okay, now you've got my interest." That's a cool question. So they explained to me that they're in second year business undergrad.
Mhm.
They had started a consulting business on AI. Again, young people, fresh thinking, going to mid-market or core, whatever their target client is. I did not bother asking them. And they had done $500,000 in revenue. Okay. Which is pretty impressive,
Yeah.
right? Second year commerce.
Yeah.
And they've been funneling that $500,000 into a product idea, into a business.
Mhm.
And they're like, "We're starting to see some momentum here. What do you think? Should we?" So their question was centered on, should we quit school?
Yeah.
And I gave them some thought. I said, "There's pros and cons to this, and here's my views on
Quit
this."
in a second.
Yeah,
It's
that's-
amazing. Yeah.
there's nothing wrong with that
Yeah.
advice. But what I internalized from that, I'm like, if they would have followed the traditional path, would have raised $500,000 to $1 million with just the start of that product idea
Yeah.
on a 10.
Yep.
And then we reverse engineer again the power law, which is $1 billion. I just think the $500,000 that you still have 100% ownership, where you're still experimenting and figuring out what your business really is and how big it'll be, and actually what you want to build at pace.
Yeah.
I just think that's smarter from a probabilistic outcome of wealth to you and likelihood of success,
Mhm.
right? So that's so services. Okay, Canada, and this is a problem for our country. We over-index to government involvement in funding,
Mhm.
which causes all kinds of weird incentives. But there is a lot of non-dilutive capital available depending on your narrative.
Mm.
Woman founder, minority founder, science founder, clean tech founder, like and what I would suggest to you in our portfolio, 75% of Canadian companies have used some kind of government grant,
Yeah,
tax
it's great.
credit, whatever.
Mhm.
So that's another category. You talked about pools of capital like angels and family offices that may want a more capital efficient narrative and may have strategic areas that are different than what is currently attractive in the VC kind of we follow the herd AI narrative. So there's a whole opportunity set there, and we see that all the time. Most companies that I researched in Canada that stayed lean for way longer than the conventional brought in some kind of an angel or family office into their cap table in a very efficient way.
Yeah.
Okay. Private equity. We've had a number of companies in our portfolio and in our ecosystem that bootstrap for so long, they started to reach the size that a PE 3 to 5x, 5 to 7 year return made sense. And generally speaking, their path became a secondary for the founders to de-risk a bit and some capital for M&A.
Yeah.
Great. Debt. Long discussion about when it should be used, but if you get to a certain ARR, you can start to think about layering that on. Tokens. I thought after Sam Bankman-Fried and FTX and all the problems with that world and kind of the violation of securities laws and so on, I thought that was going to go into the wasteland. But clearly we have a whole new mentality to this, and we're starting to see companies do that again.
Yeah.
What I say to founders is, you should look at that. Don't go to jail. Follow the securities laws. But between the Genius Act for stablecoins and I think this Clarity Act that's coming,
Yeah.
real opportunity ahead.
Yeah.
And again, the list goes on and on. There are lots of ways to fund your business and adjust your mentality and kind of shut out or balance the continuous one track talk that comes at you as a founder, and actually consciously look at the world more expansively, which we should all be doing on all issues. So there's a few thoughts on that.
So there's a couple things I wanted to bring up, and it's something we haven't talked about yet, but I know you know this very well, is what we're not talking about is the how can I, the challenges that a founder faces if they take on VC
Yeah.
and they're one of the 40.
Yeah.
Or they're even one of the companies that's returning 1 or 2 times. Like
Yeah.
the amount of pressure that they're getting from their investor
Yeah.
is very high.
Yeah.
They're not having a happy investor who's interested in spending a lot of time opening doors for them, I don't imagine. They're kind of either forgotten about, or, they might even be pressured to shut down because they want the write-off.
So,
And that's rough. Like you've been building this company and you think you're doing all right, but you're having trouble, and all of a sudden your investor who came in and was your cheerleader is just not returning your call.
that's a good kind of comment, and I'll react as follows. The VC business model, properly, because the distribution that I mentioned is engineered such that they should only be spending time with the companies that break out.
Yeah.
Because they know what the distribution looks like. Why? Like their hours are very limited in a day. Why would you spend time if it's now clear this company is in the 40 when you have a company that is on the track to the 100x, and every second put into that makes way more sense than over here.
Yeah.
Right? This is what makes your bacon. So it's actually logical. It's how the incentives are built.
Yeah.
And again, what I would say to founders is you can't be surprised by this.
Right. That's what I think is important.
Look,
right.
There are 3 things that I say to founders that you need to understand intimately before you raise venture. Actually, sorry, 4 things. One is there are all other paths, and you should really run those to ground. Number 2 is 3 things. What is a power law return, which basically informs you that you are going to be, you're very highly probable to be on the wrong side of the distribution.
Yeah.
And what happens then? 2 is, what is the definition of what everyone calls, or VCs call, an outlier founder? What are the attributes in you that they are looking for? And do you want to be that type of founder?
Right.
You can only make a choice here, right? And 3rd is, what is venture scale growth? What does it mean? And once you understand those 3, you can start to put all of that in the context of what you're doing and what you want.
Yeah.
Okay. And so to your statement, yes, if you raise, you know how this kind of goes, right? These 50 companies get funded over an investment period. You start to watch as an investor, and you see what breaks, positive and negative. Okay. And I've heard comments, I won't say the VC, I won't say the company. The CFO of the company said to me he had a lunch, they were into their life with this VC. And he said, we went out for lunch, very prominent name partner at one of the most prominent VCs.
Yeah.
And he said to me, this will be our last lunch. No offense, but I won't actually even say the company name, but one of the true darlings of the 2010s. And I need to spend my time there and on my other funds that have these types of companies. And it was done completely rationally and inoffensively.
Yeah.
And it's like, we can't be surprised by these things. We actually just have to be aware before taking the capital.
Yeah.
And look, if you're a founder who falls on the wrong side of that distribution, then you get into a narrative about, can you just recognize that the growth is different than what the power law returns? Can you go to that VC and say, I'm going to restructure in such a way, I'm going to park you here, I'm going to change the way I'm building this business, I'm going to go to a lower growth capital efficient narrative, and I'm going to figure out a way to give you a clean, soft landing as quickly and efficiently as I can.
Yeah.
And you'll get your write-off if that's where it goes. You'll get a hope note if it makes sense to try to give you, in case something breaks positively or whatever. You will no longer think about this, but I am also able to build my business on the back of what it actually is, not as opposed to what I kind of wish it to be. And that is a complex, difficult narrative. Usually it doesn't go that way. Usually you kind of die.
Yeah.
But there's a positive way to think about that. The reality is that you should be assessing as a founder very efficiently your use of time if you find yourself in that situation, because most probably the better use of your time is to move on and reset your next narrative from an equity value perspective to you.
Yeah.
Okay. And it's done in a very professional way.
Yeah.
And it's done in an honest way. And how the other side decides to react to that will determine a lot of different things about what will happen there. I can give you, there's funds that have arisen that are built to enter these situations and basically clean up the situation.
I've just seen that. Yeah.
So as always, if there's a demand for capital and LPs kind of like that narrative, I'm quite intrigued by the recap narrative so a business has been VC funded. It's not 100xer, but it actually is doing 30, 40, 50% growth a year.
Yeah.
You can see profitability or break even, and you now need to clean the cap table.
Yep.
I kind of like those narratives. There's always interest from investors in almost any sleeve of capital. So again, in the US, it's bigger. There's a whole industry around this, and so on and so forth.
I like that you outlined kind of what that pathway can look like, because it sounds really rough, but if there's a pathway to keeping your company and continuing to grow, that's lovely versus just shutting down. I mean, we've seen a lot of this happening for the past 2 years.
Yeah, I don't want to create too much hope on that narrative.
Well,
It is, a lot of it goes the wrong way. And look, a bunch of it is because the companies actually don't even get to a point where they're even interesting for the keep going narrative. And actually there is a founder discussion around at what point do you just stop, because you're in the law of diminishing returns of time.
Yeah.
And you look at, I know the counter to that, all these companies that go, and then they have their breakout. There's a real trade in there that has to be thought through.
Well, there's a huge sacrifice that those founders are making.
Oh yeah.
And I think trying to figure out when to call it, if you're even considering it, is I mean, I don't know how to make that decision. I've had to make that decision. I made it too late.
Yeah. Generally speaking, it's made too late.
Yeah.
So you are consistent. It's very hard to walk into my office and 5 others to get diversity of thought.
Yeah.
And 4 of the 5 are like, actually, I want you to be very clear-eyed. I want you to go look in the mirror, and I want you to be as emotional as you want to be, but on a balance of probabilities, pros and cons, you should shut this down. It's very, very hard mentally.
Yeah.
And I get it.
Yeah.
Right?
So I had to shut down my startup after 9 years, and then I was sitting on my couch crying, watching Game of Thrones, and I got hired.
Interesting show to watch.
Got hired to take over another VC-backed company, whose founder had broken her back. Literally was signed up for spinal surgery because she had broken her back building her company.
Oh my God.
I walked into the situation, and I didn't do a lot of due diligence. I was like, you're paying me, great. CEO, great. I can go to my college reunion, awesome. Like, that's literally about as much thought I put into it. And the product was great. But I walked into a situation where they were having negative growth. They were losing, they'd been up to $2 million in revenue, and it had halved and then halved again.
Got it.
And I walked in, and it was a gift to me to have to evaluate a company that I had not built and work with a board and say, we need to shut this down.
Yep.
We need to shut this down while we have the resources, because unless we can raise money with this narrative, this isn't going anywhere. And so, I had a very emotional situation where I did it with my own company, and then I had the gift of having to do it again. So I was able to make that decision. But it's such a tough decision for many people because you're so emotionally tied in. Everything in Founders is all about resilience and grit and keeping on going until it works.
Yep, exactly. Well, how would I react to that? So I guess I would say a couple of things. You presented something very interesting. So first-time founders,
Mm.
so many decisions are so difficult and complicated, and it changes so much the second and third time around when you're so much more clear-eyed. So here's a direction I would go. Um, when I look at second-time founders and how they finance their businesses, generally I see two things. One is they understand that institutional world much more clearly, and they're like, I'm very deliberately not going to add that to my cap table. I understand the benefit of staying lean for longer, bootstrapping and so on, and there might be a day in the future, but I'll do it on my terms, and I'll have done it more like Toby Lutke at Shopify.
Yeah.
There's another type of founder who fully understands the institutional game, and they're like, I'm going to go all in on this.
Yeah.
I'm going to use my credibility, and I'll do 2 on 10, but with a PowerPoint on my track record, and we're going to go high velocity. And if it flames out, I understand that.
Yep.
And I find that really interesting. There isn't really a middle ground. They get the two paradigms, and they're not messing around.
Yeah.
So that would be one comment I would make. The second comment I would make is for first and second time founder, it doesn't matter how many times you're a founder, it is so important in my world to build 3 or 4 mentors that give you diversity of thought, but they can also be very candidly honest, and you build a feedback working relationship with them. And you actually consciously have checkpoints around, is this all making sense? Yes. And it doesn't mean that you are going to agree with what they say, but you're going to hear 4 voices give you some perspective on this. And I don't know if it speeds up smart decision-making, but I feel like there's utility to it if they have proper context for your business and so on. And I get that that's not the conventional grit resilience narrative, and everyone will always pull an example of they were in the wilderness and then they did that last pivot. They were going to give the money back and boom. But balance of probabilities, thinking a little differently than that conventional wisdom, I think you should think about it more expansively.
Yeah. What I love about that is there's 2 things. I find a lot of founders that I've met are paralyzed in making decisions sometimes because they're so scared, and they're trying to convince, like they're stuck in this liminal space between 2 options for too long. I like that having a board of advisors, if that's what you want to call it, or just mentors, and quarterly check-ins gives you an appointment and a time to evaluate things, like a checkpoint. So you can go forward and move really fast and more committed for a period of time, knowing that you have this checkpoint versus every morning being like, what am I doing? Because I see a lot of people, a lot of founders at different points are like, have I ruined my life or am I killing it? Right? And if you're stuck in that, am I ruining my life? You're not going to move fast. But if you have quarterly checkpoints or however often, you also know that that's your chance to evaluate. Move away from oh, things are going great, we are growing, this is amazing, to now's the time I have an appointment with myself and with advisors to actually evaluate and decide what we're going to do.
Perfectly said. Super aligned with how I think about mentorship. Perfectly aligned with how I think about the purpose of mentorship. And the other thing that I'll say is, I say to founders, often they do an accelerator, YC, they do Techstars, they do whatever, right? In Canada, there's one called Creative Destruction Lab that's very prominent. I don't know if you've ever heard of it. Very mentor-centric. One of the things we do at Creative Destruction Lab is we do 8-week sprints, and then they come together back with their mentors.
Yeah.
At the end of that day of mentorship, they end out with the 3 core objectives that have been hashed out over the day and kind of agreed to like both sides. And then they do the 8-week sprint with a focus on those 3 objectives. Then they do that all over again. Okay. People love that format. Okay. No more than 3, no less than 3. It's been figured out in that world that you don't have the bandwidth and resources for 4. And in fact, you don't need 4 because they're all on the journey to product market fit. And there's actually 3 things they should do.
Yeah. And
they are so distracted every day and so on that it focuses them.
Yeah.
And then you come back and you do that thing that you're talking about. You do the checkpoint. How did you do on the 3? Do we keep one rolling forward?
Yeah.
How stressed are you? What are you feeling personally? A whole big aspect of mentorship.
Yeah.
And then you do it again. And what I say to founders is I explain how this creative destruction lab works. And they're like, well, I want to do that. And I said, well, go get a couple of mentors and you don't need the program.
Yeah.
And so I say, if you find something that works in a structured program,
Yeah.
YC or whatever, do it long term.
Yeah.
And I think that that is a very useful thing to keep in the back of one's brain.
What I love about that as well is the personal inquiry as well.
Oh, yeah.
Like, how are you doing? Is this something you want to spend the next 15 years of your life building?
Exactly.
Is your life falling apart? Like, are you okay with that? Like all those
I've
questions?
been there.
Yes.
I've walked the road.
Yes.
This is how I dealt with it.
Yeah.
Asking great questions, telling stories of the journey where things were at a low, where other Portco's founders were at a low,
Yeah.
and like experience sharing and so on. And look, a mentor, I was doing a mentor workshop, and I learn every time I do one of these workshops, right? Because people tell me how they do things and so on. A guy said to me, I open every mentor session with, on a scale of 1 to 10, 10 being the most stressed, 1 being the least, give me your number of stress.
Yeah.
And he said, depending on that answer, they may throw out the agenda and completely go in a different direction. I'm like, man, that can be so helpful to a founder.
Yeah.
Right? Because we don't get that.
I might steal that.
Yeah, we live in a, like we live in a world of, as founders, that's very isolated and internalizing the pain. And when things aren't going right, it's all in your shoulders and everything can really break down. And I think that there's a better way, and hence the part of the inspiration for the mentorship stuff that we do.
Yeah, but I'd like to hear more. Like, tell me a little bit more about what you do with MindFrame Connect.
Yeah, please. Yeah, sure. Thank you for the opening on this. 2018, at this accelerator creative destruction lab, we'd sold the operating businesses. I'd probably had mentored by that point multi-hundred founders. And I walk into this mentor day, and the genius of this one is you never mentor by yourself. You always have other mentors with you. So you see other mentors in action. And I saw over the course of that day, probably 50 different mentor styles. And I had never done that before. And I walked out at the end of that day and I said to myself, I don't know how to mentor. And that is a frightening statement. And I am the type of person that when I say that, kind of fall down, I do try to improve.
Yeah.
So I spent 2 years, Techstars, group mentorship, this accelerator, a bunch of other stuff, seeking out mentor opportunities in a smart way, resources, and so on. And then in 2020, pandemic hits, we go into lockdown. We went on a mentor blitz for about 3 months. And when the summer hit, Canada was locked down for that whole summer. I said to my business partners, you know what, guys, I'm going to hire a research assistant. I'm going to write a book about mentorship. And they said, go for it. So I hired a research assistant, interviewed 150 people, US and Canada, on the topic of being an effective mentor and an effective mentee. And we were going to write the book. It turns out no one reads anymore. That's a whole sad thing. And so we created a workshop, a dynamic workshop, and a not-for-profit. And we call it, what do we call it? Elevating the craft of mentorship.
Yeah. And
we have a second one, elevating the craft of menteeship for founders. So you need both sides of the table to work well. We've done it a couple hundred times, and it's a kind of across Canada in many settings. Yeah. And I'm very flattered that I think we've helped move the needle on mentorship. We also, because of COVID and the fragility that COVID revealed in startup land, we actually interviewed 100 experts on the topic of resiliency, very like special operations military, entrepreneurial psychologists, first responders, athletes. And we created a workshop we ask founders for 1 hour of their time. And we say, we think you will come out of this with 3 things. I don't know what the 3 will be that you will use that will make you better as a founder and your teams and your organizations to be more resilient as the stressors hit. That we've done 100 times, well received. And then we added founders play your own game, as I said at the beginning. And so I run around Canada. They're 1 hours. And I just want, I'm not getting paid for this. I do it because my impact is to try to harness 30 years of all of these learnings, the investigatory research work we did with the experts, and hammering it all together in a cohesive way. And they keep asking me to come back. So I'm going to keep doing it while they do.
Is there any way for people who are not Canadian to see some of this work?
Absolutely. So there's a website, mindframeconnect.com. But you know what? I do a lot of this virtually.
Yeah.
If there was a program in the I have done it in the US virtually. And if there were people that wanted to talk about a workshop, hit me and I'd be happy to chat.
Yeah, because it sounds amazing. Like I was like, oh gosh, I've got to read this mentorship book. I didn't see it, and it
That's
doesn't
what
exist. I was like, oh
there's a
no.
manuscript.
Yeah, I did some research,
Yeah.
but I didn't do that.
Yeah,
But
exactly.
it doesn't exist, so that's good.
Exactly.
Phew. I'd love to hear how you split your time. Because you have Global Live and you have MindFrame Connect.
Yeah.
And how do you manage?
Yeah,
things?
great question. So how it went we were 1,000 miles an hour as operators, right? Scaling.
Yeah.
Very weird, that day of the exit, and then the next day you don't have a job.
Well, can
And
you, okay,
yeah.
can we just tell me about that? Because that's a huge life-changing situation.
Yeah. It's really interesting. And well, here we go. March 2016, we sell the wireless company.
Yeah.
September 2016, we sell the non-wireless telecom businesses. At the end of September of 2016, we went from when we were wireless and non-wireless, I think there were 2,000 employees.
Yeah.
Okay. On September 30th, there were 6 of us sitting around saying, what do we do?
Whoa.
And it is, look, if I could summarize, I mentioned I was in the group of 35 exited founders.
Yeah.
One of the biggest issues that a bunch of generally 40 to 65-year-olds talk about is what do you do after exit because you're so wired a certain way.
Yeah.
And how do you have purpose?
Yeah.
How do you reclaim some of the lost years?
Yeah.
How do you enjoy life because you don't know how to enjoy life?
Yes.
And look, it's funny. Bunch of fairly wealthy founders sitting around talking about purpose. Like it's a completely interesting, different world. So for me, it went like this. We did not hang up our skates and just close up shop and take the proceeds and kind of sail off into the sunset. We were very motivated to go, act 2 or 3, however you want to define it. So we literally enjoyed a weekend off. I think we traveled and took a week or 2 to enjoy ourselves as a group, actually.
Yeah.
And then we said, are we doing
You
this?
didn't just peace out with those people. That's so
No.
funny. You
We
traveled as a
stayed.
group?
Yeah, we were very personal friends.
Yes.
Traveled with families. It was awesome.
Wow.
And then we said, are we going to do this? And the decision was yes. We set up that investment company. And look, I had done some investing. I am an accountant. I have some knowledge of it. But basically, I got a new job with the same people. So I didn't have to reset myself with a new team.
Yeah.
But I had to learn a whole new craft. And the building of a family office is a really interesting thing. And so I've spent the last decade doing that. And over time, you maybe you get a cadence, you start to get it under control, you start to be deployed. Family office is different than venture, right? Venture, you're raising funds all the time.
Yeah.
In family office, you have a pool of capital. We do some SPVs where if we're leading on a deal, we might bring some others around.
Yeah.
But for the most part, it is our own capital and it recycles at a much different pace than raising successive funds.
Yeah.
So that's I don't know, a third plus of my time. And then the rest of the working time is generally impact, the stuff we're talking about. And I've also as I've gotten older, I don't want to use obsessed is the wrong word, but we all have obsessive personalities in the worlds you and I run in. I've gone very deep on thinking about public policy in Canada in particular. We've really kind of gone off the growth narrative, and we've gone in directions that I'm not happy about, and most entrepreneurs in our country are not happy about. So I co-founded an organization focused on trying to bring back a growth narrative to the country. We've had some success with it. So I do some public policy stuff.
Yeah.
That'd be my life now.
Yeah. And when you're not working?
I have a lovely wife. I don't have kids. I travel a lot. I socialize. I love good food and wine. I like to exercise, all that kind of stuff.
Amazing.
Yeah.
I mean, when you're talking about the exit and finding purpose after that, what I was just thinking about is like when I've run races, right? Like you spend 6 months training for this race, you cross that that the finish line, and I just felt like, well, now what do you do? You know? And so it's funny to hear that there are so many people dealing with that for much bigger,
Everyone,
much longer
ev-
grinds.
every
Yeah.
founder that runs at that velocity deals with, I can say there's not one that doesn't.
hmm
And they hand-wring about whether they start another business.
Yeah.
They hand-wring about, should I be cutting angel checks? They hand-wring about, should I be mentoring founders? They hand-wring about, am I really going to enjoy, travel sounds great, but once you've done it for 5 years, 3 to 6 months of the year,
Yeah.
is that interest? So literally everyone in my interactions grapple with this.
Yeah.
And look, it's an interesting thing, right? You run, I love a half marathon. That's my
Yeah.
distance. I've done 7 in this structured Ottawa thing called the Army Half. And the first time I did it, I'm like, oh my God, that was a great training thing. What do I do next? And the next run I went on was kind of boring. Like, what am I doing this for? So I went and signed up for another one.
Yeah.
I think that's partly our personalities
Yeah.
too, right? Force yourself to make a commit.
Yeah.
And that's the way I find, for me, I do.
And I think it's funny what you're saying about travel too, because many people travel, and if they try to disconnect and live elsewhere off the grid, they end up starting something
Exactly.
because it's just their personality.
Yep.
Like I moved to Costa Rica to surf, and I ended up starting 2 companies, you know, and
Totally.
surfing. But it's just like,
You see the problems
Yeah.
everywhere,
yeah,
right?
and
They're
you know you can
everywhere.
do something about
You're wired. Look, if we could ever figure out how to give our North American kids the gene to be obsessed with solving problems
Yeah.
as one of their life's work, wow, would we be better off?
Yeah.
Right? Because look at what we have without having that gene across the populace. I think it's one of the most interesting things of entrepreneurs.
Yeah. So do you have any advice for, founders who are early in the game? They have not raised yet, or maybe they've raised from friends and family, maybe an angel. How can they get most educated on this, on the choices that they have and the trade-offs?
So, yeah, there's, as we've talked about, 99% of the media, of the oxygen, of the mentorship, of the accelerators, of the universities, of X, Y, and Z are tailored to high velocity, generally an institutional capital as early and as fast as possible.
And high failure rate.
And super high failure rate.
Yeah.
Okay. So that's what you're up against if you just kind of cruise through startup land.
Right.
So what you have to do is you have to force yourself to look at alternative sources of information. And actually, I'll talk about that first. And then I'm going to talk about the other thing you have to do, which is you actually have to, if you listen to the advice in that world of institutional, you actually have to turn everything they tell you on its head.
Yeah.
Okay. So let's talk about resources. As always, the US leads. Okay. There are 2 podcasts that I'll immediately recommend. One is called Practical Founders, and it's literally profiles of founders that have done it a different way.
Amazing.
It's amazing.
Yeah.
It's just, there are, last time I checked, like 130, 150 episodes, and you just get they grew to 20 million in ARR, no money raised. This gentleman grew to 50 million in ARR, no capital.
Yeah.
This person did that. It's amazing. Example after example, super inspiring. Occasionally, the host will bring on capital providers that talk about the business model of VC in a learning way. They will talk about other sources of capital that are different. They'll bring a debt fund on, whatever the case may be. You're getting this complex, comprehensive narrative around another way. Another very popular one that's been around for a very long time is called Startups for the Rest of Us. Okay.
Yep.
Yeah, you know it. Startups for the Rest of Us has been going for even longer. Same theme. And in fact, as we were talking about before we started, the host of that has a conference on this theme called MicroConf, CONF. Okay. Those are my 2 favorites to get started.
Yeah.
Okay. Just, you're in your basement listening, it's right there for you.
Yeah.
Okay. If you start doing some searching on bootstrapping, on, high velocity bootstrap companies and who their founders are, and then start following them and then looking at their narratives and so on, you will very quickly build up a resource set
Yeah.
that is amazing.
Yeah.
Now, the other thing, I've done a bunch of this work trying to figure this out. I will send to you the latest version of my slide deck.
Which is brilliant.
Yeah, there's a bibliography page.
Mhm.
And if you see value in posting any of that to the show notes or however you do that, it's there for you.
Oh, you know, I love it. I've
Yeah.
already posted
Yes,
on LinkedIn.
exactly.
So you know I'm a fan.
Yeah, and for your listeners to this, given we're now in like direct context,
Yeah.
but once you get going in this world,
Mhm.
you will see so many founders that either got burnt
Yeah.
or never bothered to go down that route and had success,
Yeah.
talking about it in a very raw and honest manner, and it's quite inspiring. So that would be point one. They're out there. The resources are out there. Point two is you have to basically ignore all conventional wisdom.
Mhm.
So what does conventional wisdom say? You have to fund, on the idea with some kind of high aspiration narrative that you're going to change the world, you're going to build $1 trillion kind of opportunity.
Yeah.
Okay. That's not this world. This world is you're going to be lean, you're going to bootstrap, you're going to figure out market, product, customer, and you're going to raise very efficiently
Mhm.
and very carefully.
Yeah.
Totally opposite narrative. You're going to be in the wilderness for a while.
Mhm.
Totally different. You know that narrative about how you have to have A+ talent? Well, guess what? A+ talent costs a lot of money.
Yeah.
You don't have a lot of money. You are the A+ talent founder. That is your job.
Mhm.
And you know what? You're going to pick a few spots where you'll bring in the superstars as you get some traction,
Mhm.
but you are the A+ talent. Okay. Irrefutably. And if you keep going, you'll find that almost services revenue is the devil. No, it's not. Used smartly to avoid dilution
Yeah.
in this context, it can make a lot of sense.
Mhm.
So what I say to founders is if you're going down this path, it's almost a complete waste of time to go to accelerators that are programming you for a demo day and for that type of raise. Nothing wrong with it, but just understand that's not useful advice that you're going to get for what
Yes.
we're talking about.
Yes, you're going to be immersed in advice all directed towards this one
Correct.
pathway.
So,
Yeah.
and you and I could go through each generalizable piece of advice. And actually, sorry, I'll throw one other thing. The world has changed on us with the advent of LLMs and agentic.
Mhm.
And you look at how lean you can now build a startup versus the old days.
Yeah.
It's actually a better narrative now for the founder that wants to stay lean because the tooling is there and the need for human capital to fill everything has completely changed.
Yeah.
So I think it's a golden age for this type of narrative. And again, what happens at the end of it, if successful? You own your company.
Yeah.
You control your company. And you can run these things, if they're working, forever. You can M&A them. You don't need $1 trillion values because you own so much of it.
Mhm.
And it's just a different equation.
And you
All
get to make
parts
the
of it.
decision.
And you control your own narrative.
Yeah.
Yeah, you know what? I think maybe one other thing I'll say, I know we're probably getting on here, is control of narrative.
Mhm.
Okay. In my deck, I caught in the All-In Summit, it was either 2 or 3 years ago,
Mhm.
Bill Gurley, who is, as we know, like world-renowned venture capitalist at Benchmark, super smart,
Yeah.
kind of really like a heroic investor. He made a comment that really stuck with me, and I'll misparaphrase it, but he talked about the structural cyclicality of the venture business.
Mhm.
And what he said is, I think he said he was talking to Howard Marks, the big
Yeah.
debt investor.
Yeah.
And
Mhm.
Howard was asking him about the VC business model, and he was kind of explaining the power law and the bets and the failure and this, that, and the other thing. And Howard was like, that's a strange model, kind of thing. I'm probably, saying it wrong.
Yeah.
But what Bill said is he said the VC cyclicality is a sawtooth.
Uh-huh.
And it goes up in a sawtooth, and then it goes straight down on the crash, and then it does this again.
Yeah.
And it goes down. Okay. And,
We've seen that.
we've seen it multiple cycles.
Yes.
So it's validated.
Just recently.
Okay.
Yes.
Exactly.
Yeah.
And we're starting to move up the curve here with the AI narrative,
Yeah.
right? We'll see, there's so much debate about bubble, no bubble. We're in a risk on phase. Okay. What is so interesting, the best VCs know that when you are in 2021, everything has gone haywire to the positive. The NASDAQ is an unstoppable force of nature. The capital is flowing like it's never flowed. Secondaries are everywhere. M&A is everywhere. The best know when to sell. Okay. And by the way, if I was when I'm evaluating GPs, I want your selling history by cycle.
Yeah.
Okay. That's one of my questions. Most people don't ask.
Right.
Those who, Sequoia, Andreessen, the best, they know that there's this window where, interestingly, it almost is required to be a bubble, which I find very concerning for like how to get liquidity, where that is where you open the doors and you throw everything out into that you can. Now, so I've been talking about this the whole time I've had this deck. Andreessen's and something leaked from Andreessen's presentation to LPs online that everyone has been talking about over the last few weeks. And it is, did you see this?
No, but I'm guessing what you're about to say.
Year by year liquidity that they've given to LPs.
Yeah.
Okay. Now they started, I think, 2009, if I recall.
Yeah.
So obviously the early years, you're not getting a ton of liquidity because you're in your investment periods. And you look at this bar chart by year.
Yeah.
Okay. 2011, I think it is, till 2024, 25. And you look at 2021, and it is magnitudes of any other year in terms of liquidity. And all that tells me is they're exactly doing their job.
Yeah.
Right? And those who know how to sell, wait, sniff, watch, and boom.
Yeah.
And founder, the point to this whole point is, founder, when you get that call, you've lost complete control of your narrative. And in reality, you actually have lost control of your narrative when you've raised the first round.
Yeah.
And I know we can talk about how well I have control. I'm raising this dollars on that. You don't.
Yeah.
Because you now have externals. You now have people that need to earn a return for their LPs in a certain way.
Yeah.
And I'm sorry, but the world is now different for you.
And VCs are not villains. They just have a business model. Like that's
everything we've talked about today.
Yeah.
Is a very well-trodden and understood business model. Not only are they not villains, I would argue they're the opposite.
Yeah.
Their business model exists. They have funded and built the great success stories of the last 50 years.
Yeah.
So it is not a villainous narrative. It is a positive narrative. The problem is founders do not understand what they're walking into because they're not educated about the business model. And I never begrudge a founder for taking venture. What I say is, did you know their business model when you took it? And that, to me, is the point.
Yeah.
That's it.
Yeah.
I've invested in 47 VC funds. Maybe I'll make one other comment as an investor. The problem for venture that we've seen is, and it's quite easy to summarize, okay? If we compare venture to something that is comparable, the general convention is you look at the NASDAQ 100 performance over the last 25 years. Okay, and you can do 10-year, 20, 15, whatever. Okay. The perfectly liquid, low-fee ETF, QQQ, that proxies the greatest innovation companies of our age, right? All the Mag 7 and down.
Yep.
Okay. America's true greatness shines in this index. You guys are the best in the world at entrepreneurship. You are the best in the world at innovation. Okay. And you have a proxy to show that publicly. If you look at the NASDAQ 100 cumulative annual growth rate over the last 10 years, pick your measurement date, it's going to be around 18, 19%. It's an amazingly great index. Power law returns from big guys, all that kind of stuff. PitchBook publishes all that private market data. Their latest publication, Venture Capital, 10-year global median returns, 11.5%. So here's the issue as an investor in BC. Think about that. You lock your capital up forever.
Yeah.
You pay 2 and 20.
Yeah.
And as we're seeing how long you thought you're locking it up, you're actually locking it up for longer.
Yeah.
And your median return is 11.5. There's no world where that makes any sense. Right. So as an investor in venture, it's the asset class where manager selection is actually the most important.
Mm-hmm.
Okay. Top decile, maybe top quartile, really top decile are where all the returns in venture are gained. And we know who those managers are. Let's pick the big guy, Sequoia.
Mm-hmm.
Okay. Do you know how hard it is to get into Sequoia? Do you know what size of check you need to get in as an investor? It's almost, completely shut off from the broad base.
Yeah.
So it's when you talk about investing in venture, and now we've seen the performance for so long that we know the truth, the answer always that comes back is, well, just make sure you get in a top decile manager. Yeah. Well, that's not actually, often you only know that in hindsight. Mm. And to get into the guys that can consistently and persistently prove themselves, it gets harder and harder, obviously, as they go along. And so I've really struggled with this asset class to figure out, now that I've got 10 years of hindsight, entry points and so on. So again, it comes at us in all these different directions. And it's just important for founders to understand, for family office investors to understand, for those who aren't really in the asset class, who are thinking about it, to understand and really be educated on this.
Yeah. That was amazing. I think we've got our hot clips that we're going to pull and everything else. This is an amazing interview. I really appreciate you coming in.
I've really enjoyed it.
It's so important, as we've talked about, for founders to understand what they're signing up for and having a clear strategy of how they're going to get the resources for the company.
Yep.
And one thing that never hurts is revenue and traction and building your business.
My favorite way this is a great conclusion. The best way to fund your business is with customer revenue. The best.
The best. And it also, it opens up all kinds of opportunities for these other asset classes if you choose to go with them.
Totally.
But that is the most important thing. So we'll end on that. But I really appreciate you coming in.
Thank you so much. Really enjoyed it.
Fun.
I'm glad you guys are doing this.
Yay.
Keep it going.
I'm Helena Fogarty, and this was Inside the Fund.